For more than 2 decades, the United States set the terms of trade with Africa. Washington decided who got access, who didn't, and on what conditions, but quietly without headlines or warnings that balance has flipped. Today, the U.S. isn't dictating terms to South Africa anymore. It's negotiating, it's pressuring, and, in some cases, it's chasing. Because Africa has discovered something Washington never expected, that a deal meant to offer opportunity could be turned into leverage. And now, one of America's most important trade relationships is hanging in the balance.
About South Africa as part of AGOA.
Well,
I mean, South Africa is clearly not America's friend.
That's correct. We've had some conversations with the South Africans when it comes to trade. And again, there are a lot of kind of foreign policy issues that I don't get into with South Africa. But when it comes to trade, they have a lot of barriers, not just tariffs, but non-tariff barriers, et cetera. We've made clear to the South Africans that if they ever want to have a better tariff situation with us, they need to take care of these tariffs and non-tariff barriers. They're a real economy. They're a big economy, right? They have an industrial base. They have an agricultural base. They should be buying things from the United States.
But if you extend AGOA for 1 year without reforming it, that's going to benefit South Africa, right?
It could. I would say we have a 30% reciprocal tariff on South Africa right now, which is much higher than the rest of the continent. So we'll control for it a little bit. But I think South Africa is a unique case. I agree with you, if that's your point.
Don't you think we ought to separate South Africa and AGOA?
I'm happy to consider that, right? Congress has come to me and said, we want AGOA. And I think if we're going to have a giveaway, we need to figure out how to improve it. If you think that we should give South Africa different treatment, I'm open to that because I think they are a unique problem.
Well, they're a unique problem for America.
For years, AGOA, the African Growth and Opportunity Act, was presented as generosity, a gateway, a privilege, a reward for cooperation. Signed into law in 2000, AGOA gave qualifying African countries duty-free access to the U.S. market for thousands of products. The message from Washington was clear: play by the rules, align politically, liberalize your economy, and you'll be granted access to the world's largest consumer market. At least, that was the theory. In practice, AGOA also created dependency. African exporters structured entire industries around continued access to the U.S. market. Governments planned budgets assuming the deal would be renewed. Workers' livelihoods depended on it. And because AGOA renewals were controlled entirely by Washington, the U.S. retained ultimate leverage until Africa started reading the fine print differently. South Africa sits at the center of this shift. Unlike many AGOA beneficiaries, South Africa is not a fragile economy dependent on aid. It is industrialized, resource-rich, and deeply integrated into global trade. It exports vehicles, minerals, agricultural products, manufactured goods, not just raw materials. And critically, it has options. For years, tensions simmered beneath the surface. U.S. officials accused South Africa of drifting away politically. Trade disputes emerged over poultry, citrus, and vehicle exports. Washington threatened exclusion. Pretoria pushed back quietly, but something changed. As global supply chains fractured through pandemics, wars, sanctions, and energy shocks, South Africa's strategic value skyrocketed. Its minerals are essential for EVs, energy storage, and defense industries. Its ports sit on vital maritime routes, its industrial base is irreplaceable in Africa, and the U.S. suddenly realized something uncomfortable. AGOA mattered far more to Washington than it had admitted. America's clean energy transition relies on stable mineral access. Its manufacturing resilience depends on diversified suppliers. Its geopolitical competition with China requires partners, not lectures. And South Africa sits at the intersection of all three. Here's where the leverage flipped. Instead of fearing AGOA's expiration, South Africa began reframing it, not as charity but as mutual dependence. U.S. automakers rely on South African components. American consumers depend on affordable imports. U.S. firms have billions invested in South African industries. Cutting South Africa off wouldn't punish Pretoria alone, it would reverberate through American supply chains, prices, and jobs. For the first time, the threat ran both ways. African policymakers noticed. South Africa wasn't isolated in this realization. Across the continent, governments were reassessing trade frameworks signed during a very different global era, one where Africa had fewer partners and less bargaining power. That era is over. China expanded aggressively. The EU scrambled to secure raw materials. The global South began trading with itself. AGOA, once America's strongest trade carrot, began to look less indispensable. This doesn't mean Africa is rejecting the U.S., it means Africa is renegotiating from strength. South Africa, in particular, started signaling that continued access should come with respect for sovereignty, policy independence, and development priorities. Alignment would be transactional, not ideological. That sent shockwaves through Washington, because AGOA was never designed for equals. It was built on conditionality, and conditionality only works when one side has no alternative. Now the alternatives are everywhere. If U.S. access tightens, South Africa can deepen ties with Asia. If trade preferences are threatened, supply chains can reroute. If political pressure increases, partnerships diversify. Suddenly, it's the United States weighing costs. Cut South Africa off and lose strategic minerals to rivals. Push too hard and accelerate Africa's pivot east. Compromise and accept a multipolar trade relationship. That's why American officials aren't issuing ultimatums anymore. They're traveling, they're negotiating, they're re-engaging. That alone tells you everything. AGOA still exists on paper as U.S. leverage, but in reality, it has become a mirror revealing just how much power Africa has accumulated quietly over 2 decades, and South Africa is proving that leverage doesn't always come from breaking agreements. Sometimes it comes from realizing the other side needs them just as much or more than you do. Once Africa realized AGOA could be used as leverage, the shift wasn't loud. It didn't come with formal announcements or dramatic exits. It came through posture, timing, and silence. South Africa stopped reacting. Instead of responding defensively to U.S. concerns, officials began letting deadlines approach. Reviews were allowed to drag. Statements were carefully measured. Washington expected urgency from Pretoria. What it encountered was patience. That alone changed the dynamic, because leverage doesn't need to be announced to be felt. It only needs to be credible. The United States suddenly faced a dilemma it hadn't modeled properly. AGOA was designed to pressure weaker economies, not strategic industrial powers with options. Suspending South Africa would signal toughness, but it would also fracture supply chains Washington needed intact. Auto manufacturers were the first to raise alarms. South African-built vehicle components feed directly into U.S. factories. Disrupting those flows wouldn't be symbolic, it would be mechanical. Assembly lines don't pause for geopolitics, they break. Agribusiness followed. Citrus, wine, and specialized produce entered U.S. markets at scale and at prices American consumers had come to expect. Cutting access would show up in inflation numbers, not policy statements. And then there were the minerals. South Africa sits near the core of the future-facing supply chain. Platinum group metals, manganese, vanadium materials critical for hydrogen, batteries, aerospace, and defense applications. Washington could not afford to introduce friction at the source while trying to outcompete China elsewhere. That reality softened language quickly. Diplomatic engagement replaced warnings. Trade missions replaced pressure. Concerns were reframed as dialogue. South Africa noticed and adjusted accordingly. Pretoria didn't threaten to leave AGOA. It didn't demand public concessions. Instead, it used time as leverage. Every unresolved review forced Washington to consider consequences. Every delay increased uncertainty for U.S. businesses lobbying behind the scenes. The power shift wasn't theoretical. It was operational. This moment mattered, because it set a precedent far beyond South Africa. Other African governments were watching carefully. They saw that compliance was no longer the only strategy. They saw that diversification changed the equation. They saw that strategic assets, minerals, ports, demographics could outweigh preferential access, and they began recalibrating their own approach. AGOA, once treated as an on-off switch controlled by Washington, started to look more like a shared dependency. The West's broader problem is that Africa's leverage is no longer isolated. Mineral processing requirements are rising across the continent. Regional trade blocs are strengthening. Infrastructure is being built to move goods east, not just west. Payment systems are diversifying away from dollar dependence. Each change on its own is manageable. Together, they alter bargaining power. For the United States, the concern isn't losing access overnight, it's losing exclusivity gradually. It's watching Africa negotiate from a position where saying no longer carries the same risk. That's why South Africa matters so much. It is not an outlier, it is a signal. Washington understands this, even if it rarely says so openly. Losing South Africa as a preferred partner wouldn't just hurt trade numbers, it would embolden others to press harder, delay longer, and demand more. This is why the U.S. response has been containment, not confrontation. Instead of cutting AGOA access, Washington has tried to reframe the relationship. Emphasis has shifted to mutual values, shared challenges, and co-investment. Trade is being tied to clean energy funding, infrastructure support, and supply chain cooperation. In other words, incentives are replacing threats. That is the clearest sign of who holds leverage. But Africa is also walking a careful line. Overplaying leverage carries risks. Trade access still matters. Investor confidence remains fragile in parts of the continent. Policy missteps could trigger capital flight or retaliation if coordination fails. South Africa understands this better than most. Its strategy is not rupture it, is recalibration. AGOA remains useful. U.S. markets still matter. Western technology and capital still play a role, but none of these are singular anymore. They are components in a portfolio, not lifelines, and portfolios demand balance. This balance is what makes the shift durable. Africa is not burning bridges, it is multiplying them. China is one route, the US is another, Europe, the Gulf, Asia, all are options. That reality alone forces respect, because when leverage exists without hostility, it becomes harder to challenge. The United States is now operating in a space it's uncomfortable with: negotiation without dominance, trade without coercion, partnership without hierarchy. That adjustment is still ongoing. But it has already changed how Washington approaches Africa, not as a collection of aid recipients, but as strategic actors capable of shaping outcomes. AGOA was never meant to produce this outcome. It was designed as access in exchange for alignment. Instead, it has become a mirror reflecting a new global structure, one where Africa's relevance cannot be managed through policy frameworks written decades ago. And South Africa's role in this shift is only the beginning, because once leverage becomes normalized, it spreads. What started as a quiet reassessment of a trade deal is evolving into something much larger, a continent redefining how power is exercised in global markets, not through confrontation, not through rhetoric, but through choice, and that may be the most disruptive force of all.